Hey guys, it's Willie. Today I want to take a look at FootLocker Incorporated, stock ticker FL. Over the past 6 months, it's down 40%. Wow. I knew it was down. I didn't know it was down that much. Jeez. Calm down, FootLocker. Calm down. You're starting to look like Baba. So you're looking at a stock price of about, call it $30, $29.84 if you want to be specific. So after this big drop over the past 6 months, FootLocker might be cheap. Maybe. I don't know yet. So let's jump over to our handy dandy spreadsheet and see what we can figure out by looking at some numbers. Again, stock ticker FL for FootLocker, $29.84 is the price. Revenue growing at 3%. Net income growing at 1.5% a year. Free cash flow is funky. I don't know how they managed to grow free cash flow at, yep, the calculation's right, at 10% a year over the past 10 years. It's a miracle. I mean, I think the big problem is you've seen this 903 versus the 511 in the past year. So I'm going to treat this as a fluke. I'm going to go based on sort of this range. So what would happen if we were to change our calculation to get a more accurate number? 4%. Okay. So, yeah. I think I'm going to rely more closely to this net income number to make a conservative assumption on the stock. Shares are coming down. Good. Thank you, FootLocker, for letting us investors own a larger portion of your business by doing nothing. We can just sit there and own a larger portion because they're buying back their shares. They're buying them back at negative 3.76% per year over the past 10 years. Thank you again, FootLocker, for rewarding your long-term investors. Earnings per share and free cash flow per share growing really quickly. Free cash flow per share, again, I would rather ignore this number because of this big number recently. But you're seeing good, solid growth out of them, which is surprising. I would have thought with, like, the retail apocalypse or whatever you want to call it, the downfall of retail, that FootLocker would not be doing as well as they are. But FootLocker is surprising me in almost every way. Assets, there they are. They're going up. Yay. I don't really care about assets. But I put them there if you want to look at them, for anybody who's interested. Dividends. Dividends are going up until they aren't. Over the past few years, they've decided to cut the dividend. I don't know. And 2020 was weird because they only paid 3 dividends in 2020. Why? I don't entirely know. I don't know if it was a timing issue or what. But 2020, they only paid 3 dividends instead of the usual 4, one for every quarter. And then the dividend has just kind of slid on down. So that's not a great sign, but, let's focus on the other financials and make sure that they're looking in a good direction. Debt going up. I'm going to assume that there was a acquisition or something in here. I'm going to hope so, because if they needed, $3 billion for, office furniture, I think that's a bit of a concern. So I'm hoping that there was a $3 billion acquisition in here, rather than giving somebody new office furniture. Cash, good. It's growing. Yay. Not a lot of cash. They don't have a lot of cash, but it's a smaller business relative to, the behemoth businesses that we like to think of, like Apple and Microsoft, and the big ones that have more cash than the U.S. government. Yeah, I think cash is good here. Net debt, again, you're seeing these big numbers here recently. I think if you're going to do more research into this company before you invest, which is something you should always do, understand why the debt has jumped so much and what they plan to do about that. ROIC, pretty good over time. Recently, it's come down a good bit, but still really good for a retail company. Really good. Metrics. PEs and price to free cash flows are telling us it's cheap. Really, really cheap. We're looking below 20, and you're looking at, anywhere from 9.7 for the most recent PE and 3.5 based on price to free cash flow, which is, again, influenced by that big number last year. Net debt, 4 times free cash flow. Good, even though we've seen this increase in debt, you're still looking at a low ratio to free cash flow. Good. Revenue, not so good. Earnings growth, not so good. Falling over the past 5 years. Free cash flow, though, has grown. Again, big number. I'm going to stop saying that now. Shares outstanding coming down. Thank you. ROIC, good over the past 5 years. Forecasting. On to our forecasting. I'm going to assume a 1% growth rate for both free cash flow and net income. Your multiples, I put 10s for both, simply because it's a retail company. I don't think you should be paying a lot of money as far as a multiple for a retail company. We know where retail is going. It's not a good outlook for them. Also, with this low growth rate, I think you should pay a lower PE or a lower price to free cash flow. And it's conservative. Always make conservative assumptions. Based on free cash flow, you're getting a 51.81 price target in 10 years. Based on net income, you're looking at, call it $34. Your current price, $29.84. Average R2 prices, you get a price target of $42.89 in 10 years. You're in at $29.84. You get your free cash flows. You're out at $42.89. That is a 23% IRR. You're looking at 23% annualized. So, again, FootLocker is surprising me in literally every single way. To be able to grow their numbers so well over the past, and, meanwhile, most of retail is struggling. I don't know, is it the rise in the sneakerhead culture? I feel like that's becoming more and more prominent. But I am not someone who should comment on society at large. I'm not a sociologist or anything like that. Then again, I'm not a financial professional either, so what am I doing, really? So 23% a year, you're looking really good. I think the assumptions that we made were very, very, very conservative. So I think that you could be seeing a return like this. And if you wanted to make even more conservative assumptions, like I sometimes do, let's say they lose 5% a year and their PE becomes 7. Super low. You're still beating the market. You're still beating the market at 12% a year. Yeah, I think FootLocker is a company that would be a buy. If I were a gambling man, I would be buying FootLocker. Because you're looking at these numbers and you're making a educated estimate as to what the price will be and all that stuff. And you're getting, really good, stellar numbers, off of conservative assumptions. So, yeah, I think FootLocker's looking pretty good. Do some more research into it. If you're going to be buying it, read 10Ks, read reports, read articles, read books, stuff. I don't know. Be educated. Learn a thing or two. But yeah, FootLocker's looking good. FootLocker's looking really good. Do your due diligence. Like, comment, subscribe. Comment below if you have any stock ideas that you'd like for me to look at, or any constructive criticism about the videos. I always want to make these videos better and better and better. Anything I can do to do that is very much appreciated. But yeah, beyond that, I will catch you guys in the next video.